These are the physics-based sentiment forecasts for the U.S. stock market using data as of February 7th, 2025. Our forecasts call for long-term physics-based sentiment to remain moderately optimistic, which is one step below the most optimistic level. Short-term physics-based sentiment to be pessimistic, then optimistic at the end of February. There are no flashes of sentiment anticipated within this forecast horizon. Our forecast for U.S. stock market price momentum, as measured by the 14-week RSI, is for it to trend lower and then higher by the end of the 3-week forecast horizon. Implied economics-based sentiment registers as meaningfully negative, which suggests that investors have a pessimistic view of economic and market conditions. The lower panel shows the physics-based sentiment drivers, which show the natural shifts in investor sentiment over the last 52 weeks and the next 3 weeks. Physics-based drivers explain a meaningful portion of stock market volatility, and we can forecast them several months in advance. The upper panel displays the price of an ETF tracking the S&P 500 equal-weighted index, shown as a dark blue line, alongside our measures of return acceleration, which we call the Market Resilience Indexes, or MRI. Please see the videos from prior reports for a discussion of how market direction has aligned physics-based drivers over the last year. Both the short-term driver shown in Figure 1 and the predicted price momentum, which is shown in Figure 3, indicate reduced optimism through the week ending February 21st, followed by a sharp shift toward optimism at the end of the month. Just beyond the 3-week forecast horizon of this report, both revert to a more prolonged pessimistic reading in March. This suggests heightened short-term sentiment volatility over the next 3 to 5 weeks. However, this will occur within the context of moderately optimistic long-term sentiment, which has historically reduced the likelihood of major price declines, for example, losses greater than 30%. Recent readings of our stock market return acceleration measures, the macro and micro market resilience indexes, indicate that both are currently in the down legs of their cycles. This suggests that the market's trajectory remains negative. The micro MRI is at a level of 39 on a 0 to 100 scale, positioning it near the middle of its normal range. Its recent failure to reach higher levels highlights low and declining market resilience. It would not be surprising to see the micro MRI resume the upleg of its cycle in response to the expected spike in optimism later this month. However, the sentiment forecast above suggests that any move higher in the micro MRI will likely be temporary. The forecast of the market's price momentum is shown as the solid red line. It indicates a decline in price momentum in early February. It is important to keep in mind that this forecast is based only on physics-based drivers and not economic or market conditions or political shifts currently taking place. Like the short-term driver discussed earlier, we expect price momentum to increase at the end of the month and then decline in March, which is beyond the forecast horizon of this report. The reading for implied economics-based sentiment is meaningfully negative. This is the result of recent stock market price momentum being lower than the predicted level for a sufficiently long period to warrant concern. The current condition of this measure indicates investors have a pessimistic view of economic and market factors such as high stock valuations, tariffs, slower growth, and high interest rates. It suggests a growing economic need for a stock price decline. As we move into a period of naturally occurring investor pessimism in February and again in March, negative economics-based sentiment will likely amplify the market's negative reaction to bad economic news and events. Feel free to contact me with any questions or comments. Thank you for watching.